Niladri Mukherjee, how big a risk to the economy and the stock market is the presidential election?
Clearly, it's one of the biggest risks for the stock market right now, at least in the near term. You have typically volatility tends to rise ahead of an election in a normal year, but this tends to be a little bit unique this year. And we've had heated political rhetoric, we've had lack of clarity on some important policy issues, and we have a Washington outsider pitted against a seasoned politician. So uncertainty factor is pretty high, and we think that's going to be a little bit volatile for the markets as the election nears. Ultimately, I think investors should focus on the fundamentals, and we think fundamentals are pretty decent for the stock market and the economy. We do see the economy improving, both for the US and the global economy, and we do see prospects for earnings improve as the next few quarters unfold. So I think that should be the key focus for investors.
Well, that outsider, Donald Trump, he has been targeting Janet Yellen at the Fed. So let's stay in Washington a little bit longer. What's your outlook for the Fed? Because if she, in fact, does raise rates in December, like a lot of people think she will, what does that mean for the market and your outlook?
You know, obviously, this has a huge implication for the markets and the economy. We think that the Fed will raise interest rates by about 25 basis points in December. But I think the market should be okay with that. The economy should be okay with that because the pace of accommodation should be pretty slow. The Fed has indicated that they only expect 2 hikes in 2017. They have lowered their expectations for long-run economic growth. They have lowered their expectations for terminal rate as well. So the Fed is penciling in a slower pace of hikes as well as a slower terminal rate, and the market should be okay with that. Just stepping back and looking at the big picture, we do think that monetary policy is losing steam a little bit. It's getting tired. So the world is slowly transitioning away from ultra, and I would say sort of dangerously accommodative monetary policy to more of an accommodative stance with some fiscal policy thrown in. So that should be good for the economies, that should be good for the markets, but it can create some near-term volatility, especially as it relates to the bond market where interest rates are pretty low as of now.
All right, and what about higher oil prices? We've seen oil prices pop over 50. What does that mean for the economy? Is that going to slow us down, or is that a good sign, meaning that America's back at work and we're using more crude?
I think it's a good sign overall for the economy. We think oil prices will head higher as we get into 2017 as the market rebalances. Our average for oil prices for Brent crude is about $60 a barrel in 2017. We see demand strong, led by emerging markets. We've seen supply moderate. We got the news from OPEC last week that they will cut supply on the margin a little bit, and that'll help. But even in the US, if you look at the shale industry, if you look at from the peak of 2014, rig counts are down by 70%, capital expenditures are down by 40%. That will help with the rebalancing process. So we definitely see oil head higher, but longer term we see oil in that $50 to $70 range, which is good for energy companies for their profitability, but also good for consumer spending.
All right, but if the Fed does in fact hike rates, it's going to create a stronger dollar. It's going to make our products more expensive abroad. So can you talk about the stronger dollar and its impact on the economy?
So obviously a great question, has a huge implication for asset prices. The dollar has been very strong over the last few years. In 2016, it's sort of stabilized a little bit. And going forward, we think that is the most likely scenario for the dollar, stable to slightly firm. The Fed rate hike in December is going to be supportive of the US dollar. The one other thing is if you look at the bond markets outside the US, they're in a twilight zone. There's like 12 trillion of negative yielding government debt. Even corporates in Europe are issuing debt at negative yields. So that foreign capital, that foreign money will be attracted to the US, and that'll be supportive for the US dollar as well. There is a risk of a stronger dollar if the economy really heats up in the US. And the second thing is you have to keep an eye out on Europe. If the election season gets pretty risky there, then you will see the euro depreciate and the dollar appreciate.
All right, and finally, putting it all together, how should investors take your advice? What should they do with your outlook?
Well, I think in the near term, there is going to be more episodic volatility. So investors should keep a diversified portfolio. They should have a good rebalancing plan. They should favor high quality investments, especially here in the US. We like dividend growth strategies. We also like emerging market equities. We have a neutral view on it. And I think just keeping a diversified focus, staying disciplined, looking out more long term, I think is the right approach in this market environment.
All right, well, thanks a lot, Niladri.
Great. Thank you.
Thank you for watching The Street.